What's up, guys? So in today's video, we're going to go over our weekly bias like we always do, but we're also going to take a little bit more of a directed route and go over something that a lot of traders fail to understand, and that is how to use low time frame entries. So a lot of SMC traders especially will put all of these entries where they have, 50R, 100R, and this and that, but they're not really showing you how you have to layer your analysis to get those kind of entries. And half the time they're not even getting them either. But the topic we're going to go over today is how to properly frame lower time frame entries using the higher time frames. So let's get into it. So, hold on, it's making some noise. I don't know who that was. Yeah, so one thing that I want to stress first is that whenever we're going over lower time frame entries, they gotta come from higher time frame bias. So what exactly does that mean? If we're looking at price action, let's just say we're just talking about structure. The most famous notorious entry pattern, people call it choke, market structure shift, whatever you want to call it. Maybe you use a fair value gap after this market structure shift. Maybe you use an order block. Maybe you use a breaker block. There's no right or wrong way to do that. That comes from backtesting and learning what works best on the pair that you're trading. And it's going to always be different. And that's why backtesting is really important. But the more important part is, why are you entering, the market? If you're on a 1 minute and you go back and backtest, and you look at every single change of character or market structure shift or whatever you call this lower time frame entry model, then you're probably going to notice that it does work sometimes, but oftentimes it doesn't work. So there are a couple factors that I think could help a ton of traders in limiting how many lower time frame entries that they take, and what their criteria is. And you need to develop a mechanical requirement of what it takes for you to get into a trade, and it should not just be this. Now, while this is required, it's not going to be the only thing that you want to do. You need to focus on much more than just this simple pattern, because if it was that easy, everybody would be funded, everybody would be millionaires. You guys probably wouldn't be watching my video, you'd be on a vacation with your trading money. And, maybe you are on vacation watching this video. I don't mean it like that, but we're always learning. But my point is, if it were that easy, there would be no challenge. And I mean, obviously it's just not that way. So whenever we are looking at lower time frame entries, like I said, they come from higher time frame bias. So whenever we're talking about what we're going to be looking at in the higher time frames, we're going to be looking at structure, liquidity, and points of interest. So points of interest is a term that's thrown around a lot. A lot of supply and demand traders use it. ICT traders refer to it as price delivery arrays. Some people just use order blocks. Some just use fair value gaps, breaker blocks, whatever. But points of interest to me is really anywhere that we're looking to trade from. It can be an order block. It could be a liquidity pool. It could be a fair value gap. It could be a breaker block. It could be a mitigation block. Whatever you use to frame your trade, that is your point of interest. That's where your trade gets to, and you start to look at, okay, maybe I'm going to start framing a trade here. So on the higher time frame first, you're going to want to look at your structure, your liquidity, and your points of interest. So what I like to do is, let's just say we're in a bullish structure overall. Our external structure is bullish on the higher time frame. All right, so here's our swing. The first thing you want to do, and this falls into structure, is draw your fibs. Now, there's two ways of doing this. You could either use premium and discount, or you could use a optimal trade entry to frame what kind of areas you're looking for. So that, again, a lot of you, I'm going to give you different options to use, and there's no one right way or one be all end all strategy for every single pair. Some strategies might work on all pairs, but one strategy is going to work better on one pair than it will another. For instance, I noticed that a lot of strategies that work with crypto don't necessarily work with trading indices as much, right? And vice versa. So, what we want to do is identify our structure, and we're looking at a bullish narrative in this situation. We'll just draw this a little bit clearer. So, the market's been going up, making higher highs on a higher time frame. So, first of all, what is a higher time frame? Um, the way that I like to explain higher time frames is it's higher than the time frame that you're trading on. So, a higher time frame to a day trader could be a 1 hour. A higher time frame to a swing trader might be a 4 hour or a daily. And it really comes back to what kind of trader you are. But the formula that we're going to go over is applicable to any trading style. It's just a higher time frame is higher than the one that you're looking to enter on or that you are doing most of your analysis on. So for me, when I'm trading crypto or Forex, I'm using the 4 hour as my higher time frame a lot, and then 15-minute as my kind of medium time frame, sometimes my entry time frame as well. And then if I'm day trading, I like to use the 1 hour as my higher time frame, and then the 5-minute and the 1 minute for entries. So we'll just say we're on our higher time frame here, and let's say price begins to start to pull back a little bit from this. Now, in this area, we're not just usually going to see a straight drop like that. We're going to see consolidation, manipulation, and just overall kind of crooked price action. So right here at this point, and this point, and this point, guess what probably had to happen in order for these pullbacks to continue? So for instance, when we're talking about our more internal structure, we have a low, a high, a low, high, and a low, another high. So each time we form a low, we pull up or pull back up to, whatever we're hitting here, a fair value gap, or maybe an order block here, whatever it is that you're reacting off of. On the lower time frames, the external structure is changing to get up there. So for instance, if, let's take a closer view at this. Imagine we're looking at our lower time frame, and price, whenever we're seeing this pivot right here, we're oftentimes seeing that same entry model that we see whenever we want to get active in the market, right? So you might say, okay, well, here's my order block, and I'm gonna take a long here and target the next high up here, whatever you're targeting. And most of the time, if you're in a premium like this and you're really not framing your trade around anything except the lower time frames, it could work, but most of the time you're going to get something like this. And you may have watched a couple videos on how to use lower time frame entries and then wonder, is this just bullshit? Does this not work? Why am I just continuously failing? And a lot of it comes from false expectations from trading being really easy. A lot of people, when they learn smart money, they look at it like the Da Vinci Code and that they've just found this, easy paths to success, and it's just not. That's just not the case. And a lot of YouTubers or course gurus, whatever, they'll sell that because it's easy to teach that, and it gets people going, and people might have beginner's luck, and it's just not true. So there's a lot of stuff you got to mix in with those lower time frame entries, and obviously the first one is structure. And in this example, we have bullish structure and we were trying to long. So why didn't it work? Well, because you can't just use structure alone. We're going to have to use liquidity. We're going to have to use points of interest, right? So for me, what I would recommend to anybody is use 2 of these, if not all 3. I like using all 3. So for me, I want to use, trade with the trend, the overall higher time frame. I want to incorporate a liquidity raid. I want to also make sure I'm trading from a point of interest. So, some people might just trade from liquidity raids with no fair value gap or no order block. Some people might just trade from order blocks with no liquidity raid. Again, you have to test these things and kind of take note of what works and what doesn't. So let's say we have an order block here, right? It's right at equilibrium, so it's technically in a discount. That checks off all the boxes for structure because we're trying to trade a bullish order block and we're in a discount. So let's take this and delete it. So we'll say price continues down and we tap into this zone. Now, have we taken any liquidity? Yeah, we've taken liquidity at all these internal lows because any low or high has liquidity resting under it. Now, the amount of that liquidity is difference, from here and then all these equal lows. So a lot of times we'll have, internal lows that does provide liquidity, But if we're looking at, where's everybody's stop loss? If they longed, anywhere and this leg up, most likely the stop losses are going to be under these lows because a lot of traders look at that as a buy wall or support. So we know that there's a large amount of sell side liquidity resting under that. So let's say we've come down into this order block. So we've checked off structure. Now we haven't really checked off liquidity. Well, I have said we've taken this liquidity. That's not the kind of liquidity pools I want you to focus on. I want you to focus on, the big picture. Where are the stops really resting? So in this example, let's say we get this move out and we get a pretty decent push, and you might even take some internal structure in your higher time frame. So these are tradable. They definitely can be tradable with no liquidity, but I wouldn't extend your targets. For instance, let's just draw another zoomed in example and say this is the lower time frame view. And so we came down into the point of interest. We got to break a structure. And you got a second break of structure even, right? So, you're active in the trade. You traded off this fair value gap, we'll say right here. And again, notice I'm using different examples of order blocks, fair value gaps, breakers. It's really all the same. Again, your entry model is important, but what's more important is the narrative that you're basing it on. So, sometimes the breaker block trader is going to, get a better entry and better risk to reward if they use a tight stop. Sometimes the order block trader will get left behind, but it's more about, over a series of trade, what works the best for what you're trading. So let's say you did this and you extended your target, however high this high up here was. It'd be much higher risk to reward, relative to this example, but I'm just going to draw like this for to make things easy. Let's say price, kind of comes up and then it just takes you out and moves down. And you're wondering, what happened? I got my, break structure, we moved up. This is just scam, Ponzi, right? But a lot of times what happens is, just think about all these checkboxes as kind of like a report card. So like, how valid or how valuable is this trade? Is this trade, a C plus, or is it an A plus, or is it, total shit trade? That first trade we talked about, that's like a D minus. This would be like a C trade because you've checked off structure. Yes, you've got a POI, you got your lower time frame entry, but you really don't have everything that me personally, that I would classify, an A plus trade that I'm highly, highly convicted in. So yes, you're trading with the trend. Yes, you've got your order block. Yes, you've got your lower time frame entry, but you haven't really taken any liquidity. So, no raid, no trade is a saying I like to use. And also think about it like this. If you're trading smart money, and we all know that that's mainly based on liquidity. It's based on smart money manipulating retail traders. So if that's the case, then, why are we not going to use liquidity in our trading? Why would we not do that? It just doesn't make sense to not incorporate liquidity, in my opinion, right? And sometimes this trade is going to, be the, successful trade. Sometimes it's not going to do this. It's going to go straight to TP, and that's cool. But, in my experience, more times than not, this trade will not reach the full take profit. And that's why I said it is tradable. And maybe you come up with a plan to trade it and you just trade to the next higher time frame order block or next level of internal structure, which is fine, right? But if you want to take a valid trade that's going to really push through the range, you want to make sure that you have swept liquidity, you've tapped into your order block or your fair value gap, and you're trading with structure. So we'll take out this example, and let's say you've came down here, and let's say you have a big fair value gap down here. So now we're getting to the area where you've taken liquidity, right? You took out all these equal lows. All the breakout traders are looking to get short here, and all the people who are long are now forced out of their positions. So now is where you should be really watching the market for a reversal, because it makes more sense. If smart money is trying to enter the market, or we're going to be mitigating true orders, we're going to take out liquidity before we do that. So when we look at the market, from that standpoint, we're able to not only limit how many opportunities we take and how much risk we take, but we're also able to be more convicted in our trades. And I want you to go back test this. Don't just take my word for it. Forex Replay, which I'm going to make a video on here in the next couple days. Super awesome software. It's like $30 a month. It's worth every penny if you ask me, if you're doing this professionally. So it's like down here, now you have your entry model. This is something that you're going to be much more confident in taking along from, or that I would be more confident. Because now you've taken out liquidity, right? So, liquidity's crossed off our list. We're in our point of interest, which is a fair value gap. And we're in a discount, and we're trading with the trend. So we're using all three pillars that I like to use when I'm trading, together. And we're not just kind of forcing a trade and trying to trade every single POI, because, let's be honest, if you trade, correctly, you're going to get high risk to reward on these kind of trades. You're trying to take a whole range. And this is not the only trade model that I use, or the only trade model that you can use. I'm just using this as an example to teach this this lesson. But let's say we push down to this point of interest, and then you come all the way up to this level. Now, this is going to be a lot higher risk to reward than it's going to be depicted here. But let's just say you got that 4, whatever. It's going to be much higher a lot of the time. But let's say you got 4 or 5 R on this trade. It'll probably be much higher, but you've been trimming along the way. So we'll just say 5 R. We'll just say you netted 5 R. So were you profitable, right? Yeah, you were, because you took 2 losses, and on that third trade, you took a pretty big win. So, in the end, were you wrong to take these other trades? I wouldn't say wrong or use that word, but I would say it's inefficient, because especially if you're taking funded exams, if you're just trading professionally, the trading is kind of like baseball in the sense that whoever makes the least errors is going to win, because we all know how to trade. Like, if you're going for a funded account, or if you've been trading for a while, you probably understand technicals, right? But the part that you're lacking in is inability to follow a rule set, or maybe you don't have a rule set, and you're taking unnecessary losses, because all those little, -1R, they add up. Now, I don't want to enforce fear of losing, right? Because there's a very fine line between being able to lose very good and also being reckless. And there's also a fine line between, being overly cautious and choosing your opportunities well. So as traders, it's kind of our job to walk that line. That's why trading can be so difficult. But I think that one of the best ways you can do that, if you are using lower time frame entries, is to really come up with a mechanical checklist of what you need. What do you require in order to get into a trade? So, a lot of people are probably going to say, oh, what about bias? Well, I'm getting a bias for my structure, right? I'm getting, overall areas to trade from premium discount and, order blocks, fair value gaps, breakers, really any POI, price delivery, whatever term you want to use. And then I'm requiring liquidity to be rated. So another thing I want to draw, do this little weird. So notice how, let's draw this, sorry. I didn't even draw it, that's why I was looking at it weird. So let's say this is the lot higher time frame POI, this bigger box right here. So one thing I want to point out is when I'm using an entry, I want to see this in the lower time frame. So I want to see liquidity here, right? I want to see that liquidity taken. And I also want to see liquidity taken right there. So the reason for that is, and that's oftentimes what this pattern is those early traders get stopped out. You don't really want to trade the first tap into a zone. For one, it's not a high resistance run on liquidity. So what that means is, if we get something like this, that's oftentimes going to be targeted later. You can look at that more as trendline liquidity. But if we get something like this, the liquidity's already been ran once. So we're not worried about, being early if we're entering down here. And, I think that that's super important. That last little bit, I can't stress that enough, is just wait for a tap, a sweep, and then a shift. You don't want to just trade the first tap. So Now this can work with any entry model you use. It doesn't have to be, you know, trading pro trend. It doesn't have to be trading to try to take out the external liquidity and, you know, capitalize the entire price swing. But just whatever you're doing, you know, make sure you incorporate structure, liquidity, and a point of interest. It doesn't have to be, again, you don't have to target this full range. Maybe you're trading counter trend. Maybe you're trading, the indice model early in the morning or in the afternoon. But just make sure that, you know, like for an instance, let's go over something with indices, because I know a lot of you guys after the 2022 mentorship are trading indices. So let's say you have your 830 open, and we'll just use this, something like this. So we'll say you have a fair value gap under the 830 open. We'll say here's also your midnight open. Forgive me if this somebody goes back and says it's not enough time, whatever, but just bear with me. Let's say you have both of those levels, and you're trading the the New York Hill Zone, and you're looking to get an entry based off of your bias that, you know, we're drawing up to this high right here, and that's the overall draw on liquidity. Or we'll even use, you know, low hanging fruit. We'll say there's a fair value gap right here, and that's your draw on liquidity. It's right there. So let's say 930 comes, and you start to see that flush down, right? So we're using liquidity, right, because we're taking these lows. Oftentimes with indices, you might get a liquidity raid and not tap a POI and then move up. You might think that, but oftentimes, whether it's on the 15-minute, the 5-minute, the 1 hour, it's tapping something. Whether it's an order block, a breaker block, you know, a volume imbalance, anything like that. You know, it's going to be tapping into something often, even if you don't see it. So always look through the time frames, and whenever you get a push down into a zone or a push up, especially above or below the midnight and 830 open, and then you get a push into a point of interest, you've taken liquidity over here, you've got a clear draw on liquidity, which is your bias. You know, now you can look and watch for those lower time frame entries in that zone, because you're starting to check off all those boxes. It's not just, you know, one confluence or one reason that you're taking the trade. And this also can help you develop a better strategy to backtest, because, you know, with backtesting a lot of ICT stuff or a lot of just any SMC stuff, it becomes very discretionary. And when I work with people and I see them backtest, they're not doing it correctly most of the time. They're just replaying a chart and just trading. There's almost, I won't say no point in that, because if you're very new, it helps you get a feel for price action. But if you're trying to refine your strategy, you're doing no good for yourself, because there is no strategy. If you're just looking at a chart and saying, I think this is going to go up or I think it's going to go down, and you just long or sell every time, you have no edge, right? Because you're making decisions based on your current emotion and the current look of the market or whatever you think. You're not basing it off of data and off of a strategy that you trust. And for one, it's going to eliminate your edge. For two, you're not going to be confident because you don't have any reason to be confident. You know, you don't have data to say, okay, you know, I know that most of the time I do this, it works. You don't have that. So, you know, with mechanical strategies, and there will always be a little bit of discretionary aspects to any strategy, but you want to limit that as much as possible. And we'll go over the main discretionary part of that, which to me is displacement. So the most mechanical way to ensure there is displacement in your trade, you know, whenever you're talking about the lower time frame entry, you know, that you're framing around higher time frame bias and all of the other analysis you've done, is requiring a candle close above, you know, this shift in market structure. So, you know, the first thing we require is that sweep into the zone, the higher time frame zone. And after that, you know, if we get a big push up, we want to see a displacement in the market. We don't want to just trade based off of, you know, maybe it barely, you know, wick barely came up above it and the candle didn't close. Oftentimes that's going to make a new low. And, you know, this is where it gets a little, it's going to always be a little discretionary, because sometimes, let's just say if the price kind of barely teeters up, tiny candles, and let's say this candle closes, you know, a tick above this, and somebody that's eager to trade and say, oh, it closed displacement, and then, you know, oftentimes they're gonna get stopped out. But if you are really true to yourself and kind of study price action, and, you know, when it comes down to it, when you're not emotionally influenced, you know what displacement is. You know what I mean? You can look at a chart and say, like, okay, you know, something like that compared to something like this that leaves a massive fair value gap. You know, it's easier to say, okay, that's displacement. If you're sitting there wondering about it, it's probably not displacement, because the whole idea of displacement is it's an undeniable footprint of some large force entering the market. So, you know, that's the main discretionary part of, you know, using your lower time frame entry model. But that's the candle closes are the only way I can really think of to make it more mechanical. So, but again, whenever you're using entry models like this and you're checking off all the boxes, you've got structure, you've taken liquidity, you've traded into some kind of point of interest, you can be a lot more confident in your trades. And I will say structure is definitely the most important part, because, you know, as a lot of people may know or have figured out, targeting can be the hardest part of trading once you understand the technicals, especially for indices, because a lot of people want to always target the strong high or the major high, and they're not really paying attention to what the structure is telling them. You know, they could be in bearish structure and then they get a raid on a low and they just think we're going to make new highs, because there's a term that ICT says a lot that a lot of people misunderstand, is, you know, they think the highest high is always the sell side and the lowest low is always the sell side. And if they hear, you know, sell side liquidity rate, and they're going to kind of shift and say, okay, we took sell side liquidity, now we go to buy side, and they're always going to target the high, which is just simply not how it happens. I think that term gets, you know, really misunderstood by most people. But you know, for instance, a lot of times in this example, you know, you've taken that sell side, and the most local buy side would be something like this or something like this. Now, I know people are going to say, oh, that's not. Everybody has an opinion on what the buy side or the sell side is. To me, buy side liquidity is just areas where there is, you know, a high amount of liquidity in buy stops or stop losses on shorts, and then vice versa for sell side, for sell stops and stop losses on longs. Now, obviously, we have more liquidity in certain areas, like up here and down here at the swing low, but that's not the only area people are going to have their stop losses at. It's not the only area that we're going to look at as a potential liquidity pool. So, there's so many fucking bots in the comments. Don't let me delete them for some reason. Yeah, and the video is, these are all recorded. I'm just not seeing the questions. These are gonna be recorded. So this is the usual stream that we do, but I'm gonna start to make them a little more directed in the beginning, and then we'll move into the weekly bias where we're at now. So first off, Happy New Year too. Not really first off, but just wanted to get that video started and start to give you guys some more directed, valuable content, because, you know, for one, I get tired of doing the just the same weekly bias over and over again. So I want to at least give you guys, you know, I don't know, 10, 15 minutes, 20 minutes of some kind of direct information. I'll do the best I can. Sometimes I might not, but I'll do the best that I can. First thing I want to talk about is Aussie dollar. Now, I've been tweeting about this for some time. The first tweet I put up, I think we were back in here about a couple weeks ago, talking about this order block we tapped into. We're in the premium of this daily swing range. So the daily has started to shift that internal structure. We took out that short-term low, and now I've moved back up into this order block, which I refined this way down. I went to a 4-hour, used these buy to sell wicks, and then I went to a 1 hour and used this candle. Now we spiked that just a little bit, or actually, yeah, just a little bit. Now if we use a 4-hour buy to sell wicks, I hadn't refined it, it actually went like 1/10 of a pip away. You see it's 68348, and the highest candle is 68347. I didn't trade off of that. It happened, I think this was last night, and I wasn't trading last night, but what I'm watching now is we took a low right here. So whenever I see this kind of structure and I see, you know, price trading up into a higher time frame POI, again, it's kind of a example of what we just went over. using the daily as our highest time frame, and then we go down to the 4 hour. The 4 hour structure is also bearish. If I'm looking at the overall swing structure, the external structure, I think we went bearish right here is what I'd look at, because if we look, our external structure is going to start down here, move to up here. We took out that high, so I'm going to use this. This is our low. We now took out that high, so this is our low, and now we've made a new low. So the most recent structure I'm looking at is right here, and I drew that fib. That's why I got optimal trade entry. So this goes into using optimal trade entry, and I look, okay, where is a point of interest at a optimal trade entry that's pro trend? There was this fair value gap right here, but it was pretty large. So then I hopped down to a 1 hour and noticed that there was this order block that coincided with that 4 hour buy to sell range. And then if we look right here, we had this low kind of get wicked. We got a liquidity raid, right? Price kind of paused, pushed down, tried to hold right there, and then big push down from there. So if I look at where the displacement really started, the first displacement leg was that right there. All of this right here. So I look at that, just to me, this isn't displacement. We didn't take any structure. This definitely is a displacement because it looks more like a liquidity raid, but here's we got that push. So I'm looking at that as the first area of institutional sponsorship. So I put that out last night at, hit pretty quick. I didn't think it was going to hit that fast. Yeah, 18 hours ago. So I put this up right here, and then again, look, we have liquidity. We have all these equal highs. So you see how we can layer different aspects of our analysis in order to get higher conviction in our trades. So then I'm going to jump down to a 15-minute. And, to me, I like this zone just because it occurred within this POI. Now, we had some displacement down. This didn't take structure either. We kind of came up, paused back, and then pushed down. So I will watch this zone, but to me, there's not really much valuable liquidity being taken from this zone just yet. Now, depends on how price action moves going up to it. I might consider this zone, let's say if we, really consolidate and start to form a bunch of equal highs and push down, and we have all that liquidity resting above, and then we come up into the POI, that's something I might consider. But for now, I'm more so interested in the 15-minute order block up here, because we got these equal highs right here. Also, a lot of the trailing stops are going to be right there. So anybody that didn't get in up here and just kind of FOMO'd in, their stop losses are going to be right above these highs. So that is one setup I'm watching going into this week. Overall bearish bias for Aussie dollar. I think that, and another thing too we have is DXY sitting in this weekly fair value gap. Now, I don't necessarily think we won't push deeper into it, but we are getting to that level, with the monthly order block. We've been talking about this for a while. If you guys have been on the streams, and then thank you for the subscription, Frederick. I appreciate it. But we've tapped down in here. Finally, we've been hanging out for about 2 weeks here. It's been an eternity. I think we probably will dig into it deeper. But overall, DXY is getting to that point where if we're going to remain bullish like we have, this is where we would do it. So if we look at the weekly, we've got this monthly order block up here. We've also got all these highs up here. This is a far ways off, but I don't necessarily think that it is impossible. We also got some trend line liquidity there. And then, of course, our overall structure is pretty bullish. We could come down farther, though, because if we look on the weekly, we're not really in a discount yet. So who knows? We could come down farther, but until we have evidence of that, I'm not gonna fade the dollar with as bullish as it's been. So now on ES. So I took a quick look at ES yesterday, and then this morning I hit the TP. Well, I had given out a signal if this didn't hit first. Sad day. Well, those limits are canceled. Let me do that really quick, actually. Sorry, guys. Okay, so I'll go over this really quick too. So the reason that I wanted to trade into this, I like this order block as well, but when I look at this price action with the weekly open and the 8:30 open, the midnight open was far down here, but as soon as we had that equity open, we spiked down a little bit. We really didn't trade into a point of interest, right? We pushed up immediately, on a 5 minute, we spiked down first, pushed up. If we look at what we pushed up into, oops, this is fair value gap, and or I'm sorry, not this one. Sorry, it was this one up here. This fair value gap that hadn't been tapped into. If I can get this to draw, and we took out these equal highs. So there's another example of framing entry. So we took that out, really sharp move off of that. Didn't give me the entry that I wanted. I should have just traded off this first fair value gap because I was watching this when it happened. We took that low, and to me, that wasn't enough displacement. You know, before we moved down farther, we did trade into this fair value gap. And this is an example of, you know, the way my system just didn't allow me to take this trade, so I missed out, and that's okay. You know, it'll look something like this. If we would have got a closure under that line, you know, I looked at something like that, and then probably just put my stop loss above that fair value gap, because I don't see it coming back to the breakaway gap, and I would have targeted the same target that I had down here. But the system didn't allow it, so, you know, on to the next, how it goes sometimes. But that gave me an overall bearish bias, and I had established a draw on liquidity as all these lows. So I look at this price action, especially on a 15-minute, you know, where are the stop losses, right? It's pretty clear to me you've got a lot of lows built up right there. So a lot of people are looking at it as support. So we see that we spiked that. We did hit the draw, and I was just trading the 5 minutes to try to go down to it. I didn't trade this order block because I wanted to use a lower time frame confirmation. So I was looking at this 5-minute order block. The 1 minute goes down. Now this is the kind of displacement I wanted, and I wanted to just trade into this first fair value gap. But you can see that didn't happen. And we explained this in the inefficient ranges private class in Playbit. But basically, the idea of that is that, you know, if you get this close to a draw on liquidity, sometimes that magnet, you know, starts to get bigger and more powerful. So once you get down here, there's a good chance it's going to smack into it before you're able to get involved with that trade. So miss that. It's okay. But we took that previous weekly high very early in the week and all these equal highs and had a massive push down. So at this point, I wanted us to move a little higher first, but when we took that previous weekly high like that, and I think, do we trade into this order block? Almost. On a 4 hour. 4 hours pretty sloppy. I mean, if you use the last candle, almost traded into it as well. The daily. You know, when I look at the daily, I think we might want to draw into these lows right here. So we have the previous weekly and monthly low pretty close. There's going to be a ton of stops there. So, you know, if we were to see a bullish week, we could see, you know, push down into those price levels before we see bullish price action. So tons of liquidity under all these equal lows, and it's the previous weekly low. I really like using the previous weekly low or high as a draw for the beginning of the week. You know, we already saw the previous weekly high as the draw for the first, I don't know what, 9 hours of the market being open or however long. But we tapped into that, which is a point of interest, so to speak, or an area of liquidity. And then we came back down, took that low, and I still like this order block right here, but we'll see if we get back up to it. So now we have taken that area of liquidity, so I would expect us to take off some of these levels. Butter my chart up. So if we look at this whole range, that we have that fair value gap, then we have that order block and a premium. You know, you could also go use an optimal trade entry and see that we have this whole range is optimal trade entry. So I like that area if we get back up there before taking out all this liquidity. Now, if we take that out first, then I would start to look for a rebound and go up for higher highs. Because like we were showing before, we have, you know, if we're looking at our most recent impulse structure on the 4 hour, this is what I would look at right here. And yeah, we have traveled into a premium, but we're obviously reaching up for something, in my opinion. I mean, we took out these equal lows, or equal highs, sorry, not equal lows, the equal highs, and started to move expansively down. But, you know, all this liquidity up here should yield some form of reaction. So right now I'm kind of flat on ES. I like this daily fair value gap. I've wanted this for a while. I want to push up into it, but I need more, that reaction off the previous weekly high, and us taking that this early in the week kind of makes things a little weird for me, because that was what I was looking at as a draw. If we were gonna, I wanted us to move lower first, and then we still had the area of liquidity to kind of look forward to, so to speak. We'll talk about this more later in the week. I'll probably post on Twitter as my bias shifts and on the Discord. That's about it for ES. So let's hop over to Bitcoin. Bitcoin, I like this point of interest over here. The reason I like it's right on that 705. We're looking at the 4-hour. To me, we have a pretty wide external range from the whole FTX crisis, which is all of this. And we haven't, we longed in the Discord from, I think it was right in here. We targeted this high, if I'm not mistaken. Or was it? No. I think, oh wait, I'm drawing that wrong. That's why it looked weird. Yeah, we targeted this high right here. We longed from down in this region, I want to say. I almost can't even remember. It's been a little bit. I think we long. Oh yeah, we longed from like right here, if I'm not mistaken. Or maybe it was this where we got in. I could be wrong. That doesn't. I'm trying to think. That looks weird. Just go back and look. Hold on. I'm gonna look at some of these questions too. Yes, I will look at oil soon, Sensei. Okay, so the other one too. Let me go back and look at this. Okay, here was the move this to Discord. Discord, you won't be able to see this, but you guys, probably already saw this, or we're in the trade. Oh, yeah, change it to Discord. There we go. So this was the trade we took down here, and we took the trade. We ended up taking profits at this level. Later on, we moved it to that TP. That was just the TP I took. Well, we originally wanted to move to that fair value gap, but it didn't. So overall, the trade did retrace in some form or fashion, and we did get a push up after we had that massive crash, but we didn't move back up into a premium. And while there is no surefire way that we're going to move, it's not going to want to go back now. Hold on 1 second. There it goes. It's not going to want to go or wait, sorry, it doesn't have to go back into a oh, that was okay. I'm tripping. It was way over here. So it doesn't have to go all the way back up into this zone, but I like this because we haven't came back into a premium up in here, and we've taken liquidity, and right after we took that liquidity, we took a high, and then now we're reacting pretty nicely to this 4-hour order block. We took liquidity into it, had a nice little 3 drive into it, and then got a nice push out of it. And this looks very similar to that 4-hour price action. So when we look at the 15-minute, we took that high, formed this right here, tapped into this zone, we've started to consolidate and expand again. So when I looked at what kind of shift we had after we tapped into the zone, we took out a bunch of liquidity here. So now I'm going to be watching this zone for an entry. But overall, Bitcoin, really, I think we're drawing to that zone. Now that's kind of a high risk trade. I don't want to say it's the most highest value, especially with the way crypto's been lately, but that's what I'm seeing at this moment. Let's look at oil. We'll look at oil since that's what Sensei wanted. So we we talked about this in the class yesterday, I think. I can't remember if it was you that asked in the private class in the Discord, but we took out the high that I thought we would take out and reacted pretty nicely off of it. So I think we're moving back down here. Let's say you're drawing towards that low right there. At that point, that's where I would kind of, if you don't get a very sharp reaction, like I wouldn't even want to see a 4-hour candle close under this. If you did, I would probably consider switching up your narrative to down. After all, we are in this, I think it's a 4-hour order block right there. The daily structure overall is bearish, but we are coming back down to this weekly area where we might see a rebound. So that weekly structure and the weekly point of interest oftentimes is going to kind of trump out anything else. But we still could consolidate there. So a lot of times we have these higher time frame zones like this, we tapped into it, and we have rated liquidity into it, but we haven't really tapped it, swept, and shifted. So there's a high chance that we follow this daily structure we see here and continue down, or maybe not continue down that far, but continue down under here and still could push up. We've also got these weekly equal lows down here that could be a draw. So I would just keep in mind of all that. But right now, taking it step by step, I would focus on this low. That's drawing towards that low. So you could trade the lower time frames, probably looking for that. Also, it looks kind of like a market maker sell in my opinion. So got a consolidation, kind of got your run up. You could really call either of these your run up. I'd probably call this right here. That's a sloppy one, to be honest. It's not the prettiest. Break down there. You get your second leg of distribution. So you could watch, honestly, something like this right here in that area for a trade down into this. But yeah, overall I think you're drawing to that. That's your draw on liquidity. Also, I appreciate the kind words, guys. That's pretty much it that I wanted to go over. If you guys have any questions, feel free to throw them in the chat. I'll still chill here for another second before I hop off. GBP/USD, got you, Chaco. Super nice reaction to, actually didn't hit it. In all honesty, I'd want that to get hit, this candle right here. But it doesn't look like it wants to. Also, you trade into the 1-hour order block right there. So overall, I like that zone right there. Yeah, this isn't the highest value because we really didn't take any liquidity moving into it. You see we kind of just moved straight down, straight back up. It is getting a nice reaction from it. Did you take this low? That's the question. No. You've got a nice draw with these equal lows if you get back up in there and form that. Oops. You've also got an order block kind of front running that, or that low is front running the order block. So yeah, I mean, you could watch the 15-minute zone or that 5-minute zone if we get back up there without tapping. Or did this tap it? Was it 1-9? Oh, it did tap it. I mean, there's still relatively equal lows. Ideally, what you'd want is a sweep of this. I mean, this isn't something I'd be paying much attention to. I could see it reacting right there, but I'm not super convicted in it. But those are the zones I'd be watching. Preferably a push back up into this zone if you get that. But overall, the overall structure you have here is pretty bearish. I mean, to me, I don't even know if I would consider, because like, I look at this right here and then that down. But to me, this isn't really a swing. It's just a little consolidation and a push farther, moving especially into sell side. So I would really just look at this. And I'd be careful shorting this a ton until, you know, because again, DXY I think could move into that gap. Also, I want to see the rest of the news for this week. Yeah, so we've got PMI tomorrow. We've got JOLTS, FOMC. I mean, there's a lot of news that could mess with this as well. So I'd wait for that news if you're going to enter anything. If you enter some this morning, you know, follow your plan. But I really like this zone up here. But you know, usually the U.S. dollar news doesn't treat pairs like this too nicely. So the reason I like that zone up there is that 4-hour buy to sell area. You've got this liquidity front running it. And to me, this is one swing. I'm not looking at it. Yeah, because before it was kind of here, 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 here. And then we pushed down, kind of consolidated. So I would look at this and that as its own range. And at some point, you know, once we start to see structure go bullish, which we haven't seen yet, you know, for instance, we see this, and then something like this, you know, that would tell me that we're starting to pull back up into a premium. But quick 500 cashed and closed. I don't know. Maybe just now. I don't know. Oh yeah, glad you made 500, bro. Be careful. But on that note, let me check the Discord, make sure there's nothing. Oh yeah, the class will be posted today too. That's literally, I gotta record something and then post that, and then tomorrow I'll be posting a video on a market maker model. So be ready for that. It'll be I'll try to get it posted first thing in the morning for you guys. But yeah, appreciate you guys as always. If you need anything, you know how to get at me. If you want to start a free trial to the private Discord where I give signals and teach private classes, there's a link in the description. You can use code Casper, all caps, and you get a free 7-day trial, actually. Not 5, it's a 7-day trial. It'll say 5-day on the website, but it is 7 days. So, but yeah, as always, DMs are open. I will see you guys later. Peace.